Hello, everyone. Today on the final bar, the S&P 500, the NASDAQ, another new high for the year, continuing to press to the upside. Earnings season really starting in force. We have some key bank earnings to share with you. We'll share with you two charts, seeing a nice bounce to the upside. Finally, Nick Raich of the Earnings Scout joining us from Northeast Ohio. We'll talk about one sector in particular with maybe some downside potential. Which one is it? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the best practices of technical analysis. The technical toolkit, as I learned it, was all about quantifying investor behavior. Investors get excited and desperate and euphoric and despondent and all those other adjectives to describe their mental state. Those sentiment descriptors, those feelings, those emotions are often manifested themselves in the form of price action. And by analyzing price, we can understand what's happening. We have a really interesting guest today, Nick Raich from the Earnings Scout, joining us for the first time, really an expert on earnings season. He's had some really cool custom work that he's done over the years, focusing on the most important evidence when you think about earnings. And we got him, convinced him to talk a little bit about sentiment, how that relates to earnings. I'm really excited to share some of his point of view with you, and also some of the interesting areas of the market as the long side just keeps getting longer. I've often said that strength begets further strength, and we're seeing that right now in the markets more than ever. Continue to see new highs in the S&P and the NASDAQ. When will this end? Well, the market will end when it does. As one of my mentors, Greg Morris, would say, every new high is bullish until the last one. We'll do our best to try to focus on any signs of potential topping, but for now, onward and ever upward as the market continues to print new highs for the year. Let's get right to our market recap and talk about what's happened in the market today, how today's action fits into the long term. But first, let's start with the poll. As a reminder, I always have a poll going on our social media accounts. Subscribe to our YouTube channel as well. Get the notifications on. You won't miss the next poll. We asked you which ETF performs best, in your opinion, over the next 3 months. Cybersecurity, biotech, aerospace and defense, home builders. Pick 4 different ETFs, different sectors represented, certainly different investment themes and business models represented here. I was very struck by sort of the spread between these different ones. Even the worst or the least popular answer, home builders, which arguably one of the better charts out of the 4, still getting about 1 in 5 responders. Overall, the most common response with 31%, cybersecurity, CIBR. Now, what's interesting is if you think about these 4 different ETFs, I think one of the things to remember is that you can always relate them to each other and start to think about how the patterns are relative to one another. So here I'm actually using the StockCharts ACP platform to compare all 4 of them at the same time. In the upper left, the cybersecurity ETF, upper right is biotech, lower left is aerospace and defense. Bottom right is home builders, ITB, or the home construction ETF as it's called. What's interesting is if you look at these patterns, I think one of the great benefits of looking at charts in this sort of visual way is that you can easily differentiate. I always compare this to when we used to print out a bunch of charts and then put them all on a conference room table and start to put them in piles. What are the good charts? What are the bad charts? What are the charts in the middle? And then starting to drill into the good bucket and what are the really good ones versus the kind of good ones, and sort of using that as a way to follow through them. I'm struck by these 4 charts at how consistently strong the chart of the ITB has been. If you look, we've had some persistent pullbacks or some common pullbacks to an ascending 50-day moving average, but overall continuing to show some strength, continuing to make higher highs. The most recent pullback a couple weeks ago, right around the 4th of July holiday, met with additional buyers. We're making a new high for the year here as the ITB is nearing $90 a share. The most common vote getter we got in the poll today was the cybersecurity ETF. I would certainly go with one of those 2. I might lean toward home builders, but I get the argument for cybersecurity. Certainly, it's one of those larger themes, and I'm drawn to some of our interviews with John Markman, who wrote a book called Fast Forward Investing. There's no denying that cybersecurity, AI, nanotechnology, driverless vehicles, these are all sort of the long-term emerging themes in technology and certainly in society. The question is what stocks and what companies will really be able to benefit or profit from the clear upside potential in those areas. What you're seeing right now with cybersecurity is what we call a bullish pennant formation. If you look at the rally in May and June, lower highs and lower lows, sort of this shorter correction. Now we've resolved that pattern to the upside. I get the breakout in cybersecurity. I'd agree, CIBR, pretty decent bet for further upside potential. ACP, again, a really good way to make sense of questions like that. And thanks again for answering our poll question. Let's get to the markets today and see what we can see about the technical movements and what may have caused them. The S&P 500 pushing higher, about 0.7%, closing above 45.50. And nice, again, another nice day to the upside. We're in the midst of earnings season, really toward the beginning of it. Very obviously an upside catalyst if we have companies reporting earnings and surprising to the upside. You saw some banks today, particularly Morgan Stanley and Bank of America. We'll look at those charts here in a bit if we have time. But the S&P continued to push higher. Look at the chart of the S&P as well. The NASDAQ composite, about the same, about 0.8% to the upside. Mid caps and small caps as well. And what's really interesting is the S&P 600, the small cap ETF, the best performer of the three, doubling the upday on percentage terms by the S&P 500. That lack of participation from small caps, it was one of the great question marks in the uptrend in 2023. But all of a sudden, recently, you're seeing small caps start to improve. I would argue a lot of that has to do with the sectors that are underweight in our major, in our large cap benchmarks, and a little more overweighted, or certainly better represented in small caps. And it's more value-oriented sectors like financials that you see a little bigger weight in the S&P 600 and the Russell 2000 as well. Volatility continuing to remain fairly low. And when you think of, or when I think of the year 2023 and how I would describe it from a technical perspective, it is a consistent uptrend or a chronic uptrend on low volatility. Much more like 2021, which was a pretty consistent uptrend, minimal drawdowns, 3 to 5% at most, but consistently low volatility. And that was sort of that slow and steady gain type of year. What's just interesting about 2023 so far is you haven't had sort of that big pullback, right? Besides like February, March, really hasn't been any significant drawdown. And that's when it feels like the market's a little leaning too far over the skis, a little long in the tooth. That's why we just haven't had a meaningful pullback that arguably, if you're bullish, would be the best thing to see, because that's where you could actually reset this uptrend, get a new wave of buyers coming in after some profit taking. Looking at the fixed income markets, interest rates, not too much of a change from yesterday, to be honest with you. The 5-year yield right around 4%, 10-year yields around 3.79. One of the realities of the markets here in the last couple months is that after the 10-year spiked up to around 4.25, kind of came back down to 3.25, now kind of right in the middle of that range that we've been in, and really not pushing to the upside. You're seeing bond prices remain relatively stable as a result. Interest rates not really rising, so it's not really putting the upside pressure or perceived pressure on growth stocks. Higher rates, particularly if they would go higher, arguably would make the future earnings or the future gains of growth stocks a little less attractive. You're not really seeing that. You're seeing the 10-year remain pretty consistently below 4%. The dollar index, not much of a change as well. And I think the dollar not being strong right now is certainly helping a lot of risk assets. Even gold, which we'll look at here in a moment, continue to push to the upside. Gold having another nice up day, up over 1% for the GLD. Silver prices up as well. Besides copper, which was down a bit, overall commodities as a whole having a pretty decent day, with energy prices moving to the upside as well. Cryptocurrencies, again, I feel like Bitcoin continuing to snatch defeat out of the jaws of victory. We're celebrating this break above 30,000. You're celebrating this nice follow through to the upside. It certainly feels like there's some momentum pushing cryptocurrency prices higher, with Bitcoin and Ethereum getting above big round numbers and pushing to the upside. It's come right back down. So Bitcoin, after pushing above 30,000, pushing above 31,000, now right back below, right around 29,740 here, down about 1.4% from yesterday. So not really, getting crushed to the downside by any means, but just unable to follow through. And we talked a lot about that technical phenomenon of a breakout or a key level and then the follow through. It's all about what happens after the breakout. Do you see further upside movement after a breakout has occurred? You're just not seeing that yet with cryptocurrencies, which makes me skeptical until you can get above 30,000 and stay there, that there's a lot of upside potential for Bitcoin just yet. Finally, looking at some different sectors, you have financials at the top of the list. We're sort of in the meat of bank earnings starting at the end of last week, now through this week. The XLF and technology, the XLK, both up about 1.1%. Energy was third, up about 1.1%. Only 3 sectors finished in the red today. 2 very defensive sectors, actually 3 pretty defensive sectors at the bottom. Real estate, utilities, both down about 0.8%. Staples, pretty much a rounding error, just down about 0.1% from yesterday. But that ratio of offense to defense, XLY to XLP, still very much favoring offense over defense. As long as the consumer discretionary sector keeps outperforming the consumer staples sector on a day like today, it's telling you sort of a risk-on sentiment, particularly looking at those key, very different position sectors. Let's look at a daily chart of the S&P, just see where we're at relative to where we've been. We keep going up and to the right, and we have this sort of chart. I'm immediately going back to my time at the Fidelity chart room. There's this famous story that when the Dow finally broke 1,000, if you know your market history, I think it was 1968, it hit 1,000 and then sort of had this 16, 17-year period where it did not break above 1,000. Kept sort of hitting there in the 1970s. You had the 74 low and others. We kept kind of hitting up to this point and then eventually broke above 1982 low, 1983. The Dow broke above 1,000 and then has not looked back, has continued to push higher. And famously, this big wall-sized paper chart, 1,000 was about the top of the printed paper, the paper that they were updating by hand. When the Dow broke above 1,000, they actually had to take the paper down and rescale the whole thing to fit on. So the market literally went through the roof of the chart room. And that was one of the great anecdotal stories of when a market shows strength and continues to show strength, how those trends can persist much longer than you'd expect. And I think we're kind of seeing that with the S&P here in certainly in July, right? Again, we talk about minimal drawdowns. The most recent pullbacks have been fairly mild, right? From around 44.50 down to around 43 and change, remaining above 4,300, bouncing off of this sort of support zone, we'll call it, and then moving on to make new highs today, closing above 45.50 for the first time in quite some time. If you'll note, if we do get a pullback, and this is what's so interesting when you have a market in an uptrend, you usually have some really clear support levels. So if we would roll over, I'm immediately drawn to the 4,300, 4,325 range. That would be an important Fibonacci level. That's also the August 2022 highs. Also happens to be the most recent pullback in mid-June and the 50-day moving average, all around that same point. So what's interesting is the market could pull back now quite a bit, 250 points, and still be within that uptrend and making higher highs and higher lows. That's the upside potential and the potential for a trend like this to continue. Now, let's talk about small caps, because one of the, arguments against the bull market phase has been the underperformance or the underparticipation of the small cap space. Now, this is sort of an anecdotal thing. I mean, you have to remember that not all bull markets are driven by small caps, and not all down markets see small caps underperforming, but there's a reason why that tends to be expected, because it's all about risk, right? Those smaller companies, a little less proven, a little more risky, potentially great upside potential, but you might be getting a little earlier on with some of these less proven names. So when these types of stocks start to do well, that implies that people are taking additional risk in their portfolio, and that's providing some upside potential. What's interesting about small caps is really in the last 8 to 10 weeks, you've seen a nice bounce off of the low in early May, which is retesting the low in March, and then breaking above moving averages and now continuing to push to the upside. We're now testing the high from February of last year. We're now testing the August highs. Think about the NASDAQ composite blew right through the February high, did not look back. The S&P found resistance at the February high, certainly found resistance at the August high, around 4,300, and now has continued on. Small caps, kind of the last major average to test this. We'll see if there's enough gas left in the tank to power above those levels. I think the IWM, the Russell 2000 ETF, above 2,000 is a pretty impressive breakout and arguably completing this rotation out of a basing pattern, making a new swing high. It's not there yet, but I think this week that's an important level to pay attention to. Do we get further validation by small caps continue to perform quite well? Let's talk about gold here for a moment. We haven't brought up the chart of gold or the GLD in a little while because it's been in a pullback phase of sorts. If you look at the chart of the GLD, and apologies for all sorts of different lines, I'll clean it up here as I'm introing the chart here, just to make it a little easier to see some of these key levels. But if you look at the chart of the GLD, and if you think about the trend from the third, fourth quarter of last year to the peak in April and May, nice uptrend, right? Relative performance, the S&P or the gold was actually, gold ETF was actually outperforming the S&P. It was choppy, but overall kind of getting it done and making a new high as gold, spot gold was retesting all-time highs. Now we pull back. You can see that the GLD pulled back to almost exactly 38.2% retracement of the way down from the April-May peak down to the November low from last year. Now we have bounced back to the upside. We've broken above the trend line using the most recent highs in May and June. We've broken back above the 50-day moving average. The momentum characteristics have improved. So the RSI has actually gone above 50, now gone above 60 this week. Gap higher today is sort of the latest move, I think, completing this rotation. What's interesting is you have stocks working and you have gold working. Gold usually perceived as a bit of a safe haven. The GLD is clearly underperforming the S&P over the last 6 to 8 weeks, but overall a nice bounce and could certainly be some further upside potential. Gold may be headed back to all-time highs. Let's keep an eye to see if it's able to hold the 50-day moving average as it moves higher. Just to finish off on some of the key names on the move here, I'm struck looking at the gambling group within consumer discretionary. Caesars Entertainment, ticker CZR, having a nice test of resistance as well. I'm thinking of the IWM chart, the Russell 2000 chart, had that nice rally off of the lows, but now testing a key resistance level. You're arguably getting the same kind of pattern from CZR, some of the other gambling names. The nice bounce off of $40 at the end of May, nice to around 55, which is where we're at this week. Today, moving even higher, up over 7%. Now testing this resistance level right around $50 to $55. We've closed above it. As I mentioned earlier with another chart, do we get that follow through? Do we push above resistance at 55 and hold it? Might be a really compelling entry point here as we finally break resistance and make a new high for 2023. To finish off, let's look at some of these banks that I mentioned in the introduction. Morgan Stanley, Bank of America, providing some nice upside. The MS was up about 6.5% today. So what's encouraging on this chart is it's not going down, it's going up. So that, technical analysis 101, I'd much rather have a chart going up than down. So let's start there. But let's really think about the trajectory here. Morgan Stanley was testing support in the March and May lows. We bounced and tested resistance around 90. As of yesterday, we're still kind of down here in the mid-upper 80s, and there really wasn't enough of a follow-through to the upside. Today, really pushing above, making a new swing high. Getting above the $90 level gets us above the April peak and the June peak. From a technical perspective, I always say look to the left on the chart and see where the next level might be. Big round number of $100 a share. So what's interesting about this, as long as you get follow through after today's rally, it could be further upside. Another 8 points or so would take us to 100. That would be a retest of the February high. That would be a lot of room within a chart. It's actually been more sideways consolidating, but this breakout above 90, I think, could be encouraging. And that's sort of a natural place to think of support if we do get any sort of pullback. Bank of America, I may be a little less optimistic only because it's broken above a trend line. It's broken above previous swing highs around 30, 50, but still below the 200-day moving average. One of my mentors used to say, nothing good happens below the 200-day. That was a very broad generalization about just thinking about trends and recognizing when a stock is strong enough to get above its 200-day moving average. After being below it for quite some time, usually means there's something that you want to be aware of, and not missing those sort of rotations can be one of the great benefits of scanning and looking for good opportunities. So I'm impressed with the move in both of those names. Bank of America up about 4.4% today. I'd love to see it follow through and get above the 200-day moving average. Not quite able to do it yet. Finally, Apache, and then we'll take a brief break here and bring on today's guest. Similar to what you saw with the chart of BAC, I like the rally that we've seen in Apache over the last 6 weeks. I like the double bottom that has served as support. If you would come down at all, 31 is a really clear level. Look at how many times this stock has tested that same level and bounced off of it. So you have sort of a clearly defined floor in the market. What we've not had is a follow through to the upside. We're breaking above a trend line, taking these recent highs, which I think is important. Can we follow through the 200-day? Nice update today, but not enough yet, I think, to complete that rotation. So some interesting improvements in sectors like financials and energy. I would argue still a question mark in some of those key charts. I want to take a quick break here before we bring on today's guest, Nick Raich from the Earnings Scout. And before we do it, just to let you know about a couple things. First off, we love to hear from you. We really appreciate your feedback on our show, on our guests, on your host, and everything else. But we especially like your questions. What are you running into as you were analyzing charts using the best practices of technical analysis? Our email is thefinalbar@stockcharts.com. We're on Twitter @finalbarsctv. And on our YouTube channel, just drop a comment below the video you're watching. We would love to hear your feedback and especially your questions. Hope to answer your question in our next mailbag segment at the end of this week. Also, to remind you, we're doing a pretty big summer promotion here at StockCharts.com. We have paid membership levels that really allow you to take advantage of all the things that we feature on this show. Things like customizing your chart lists and saving important stocks and charts and indicators into a group of different charts to make sense of it. The ACP platform, which really optimizes in a dynamic charting platform, the ability to understand shifts in momentum and breadth conditions. And also, of course, our scanning engine, which really helps you focus on which stocks are working, which ETFs are moving to the upside and the downside. You can find more information at stockcharts.com/special. Even if you're an existing member, you can lock in and extend your membership at a much lower price right now. So make sure you go check that out today. I want to bring on today's guest, Nick Raich. Nick is the CEO and founder of the Earnings Scout, coming to us from the Cleveland area. I used to live right near, not too far from Nick, and really it was a pleasure to get to know him, and I'm excited to welcome him to the show. Nick, it's good to see you again. How are you?
Doing great. Thanks for having me on.
Yeah, it's great to see you, and we have some charts and some slides to share with you. We're sort of going into the meat of earnings season right now. I'm really interested to see what sort of charts, what sort of names and what sort of themes are popping top of mind for you. Let me bring up your presentation. Here we go. And let's talk first about cycles. And I love how you're starting with one of the great quotes about sentiment. Start us out here.
This always holds true. Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria. Sir John Templeton's quote, I think this is one of the most simple yet most eloquent ways to describe the business cycle, the financial market cycle as well. So I'm always, every day, keeping this in the back of my head to see where we are with the earnings cycle and the markets itself. So I kind of think we're entering the optimism stage of this bull market right now. I'll explain a little bit later, but this is something that I use.
And I love Nick. You have an impressive background and really some great expertise in the earnings space. You really built a great name for yourself doing so. But I love how there's this connection to sentiment and thinking about the market phase we're in and how that relates to it. Let's start with the S&P 500 and show us where we're at. You mentioned the optimism phase. Why do you think we're sort of in that area?
Well, I'll show you just kind of where this goes from the prior bull market. That started off the COVID lows in March of 2020. No one in the world wanted to buy stocks. My friend, we actually upgraded in March of 2020, and people thought I was nuts for doing so because the government was built up and they're all going to die. So that peak pessimism was definitely the bottom. You can clearly see it. In the summer, there was all the people that said market was disconnected from reality because we were going into a recession in the summer of 2020. The market was up 30-40%. People thought it was crazy. So you had that skepticism. Then you had the optimism with the vaccines, the reopening of the economy. And then euphoria at the end. Maybe it wasn't in stock. You had the meme stocks, but it was in some of the cryptos and some of the things that were being created in the crypto world. Maybe some euphoria there. We actually have a way of measuring the euphoria with alligator jaws when we see divergences between the trends and the price that diverge for 2 quarters or more. That's when we start to get euphoria. We're not in euphoria right now. We're seeing no divergence right now. But if I had to go right now to the bull market, back in October of 2022, there was pessimism. We thought we were going for a recession for sure. And then throughout the beginning of this year, everyone was skeptical that we were going to have a inflation. And I think last week with the release of the inflation data, you got more people on board. I think we're just entering the optimistic phase where people are starting to get optimistic. And you know what? We are going to have a soft landing. Jerome Powell, the maestro, he pulled this off. And it's not short of a miracle that he could pull it off. What I'm calling, running a hat trick of killing inflation, avoiding a recession, and giving the market rate cuts. To do all three things, I think were almost impossible, but it's pricing in it. That's going to be probably happening.
Let's look at an example here, thinking about your work. And again, I think you've done some really impressive work thinking about how we should think about earnings. Can you talk us through this example of the last couple of years in a little more detail using your work about what earnings have been, where they've come from, and where you see them headed from here?
Right. So at every market bottom over the last 40 years, within plus or minus 1 to 3 months. What we see when the market bottoms, it's either 3 months before or 3 months after, we see the estimates being cut at their greatest amount. So in March of 2020, the estimates were, it was actually in first quarter earnings season, and most companies report in April. That's when most of the revisions comes, after companies report. So the market picked up on the worst of the estimates, expectations being cut in March of 2020. We got confirmation of that in April. You see 1 month later with the blue line there, the red's the price, where the estimates were being cut on 25%. That's a proprietary blend of where we take estimate revisions of all the companies in the S&P 500, and we look at multiple quarters, multiple years going out, and determine that they were falling right at 25.06%. Every market bottom occurred 1 to 3 months of the worst of the cuts on a rate of change basis down. There was the March of 2020. Clearly, you can see it. And when you get the improvement, you can have estimates being cut and the market justifiably going higher when they're being cut at lesser rates. That's an improving earnings trend. And that's what we look at. That's very similar, I think, what we do on the earnings front to many technicians. We love looking at higher highs, lower lows, and the like, but on the earnings front with the revisions.
Now, you mentioned, you sort of gave a little foreshadowing talking about the alligator jaw. Where have you seen that? What does that really represent?
So every sell-off over the last 40 years of major significant had an alligator jaw open beforehand. We've never had a 20% pullback in stock prices when there's no alligator jaw open. So we have no alligator jaw open right now. And the way we define that is when the estimates on a rate of change basis go south while the price keeps going north. And so if you look in 2021, so in the second quarter of 2021, that was when earnings peaked on an absolute basis, the S&P 500 90% growth. But after companies reported in second quarter earnings season 2 years ago, the estimates were going up at a rate of 5.15% afterwards. And then in third quarter earnings season, next year, the estimates are still going up, but they were only going up at a rate of about 3.4%. And then they were flat. So there's 2 quarters. That's 6 months where on a rate of change basis, the estimates were weakening. All the while, the price kept going higher through the end of 2021. So at that point, my firm, we downgraded stocks at that point. When we have an alligator jaw, when you have that divergence, any piece of negative news, anything in there, that's when you get those valuations. And keep in mind, the S&P 500 multiple at the time was about 21 times earnings at the end of 2021. But to me, the risk isn't the same as it was back at the end of 2021 because the PE ratio, I think people always misuse it. It's like the static ratio of those people, but the markets are dynamic. You really need to know, is E getting better or worse? And not the past E, not the confidence, but the expected E. And you see that towards the end of the chart here. The markets bottomed in October, on October 12th, right? The S&P 500 bottoms. Then what we see is companies report third quarter earnings season, and you get most of the revisions at the end of October, end of November. And the market was picking up on this, that those were being worse in the cuts this cycle. And you can see they were being cut at a rate of 5.42%. So without fail, markets have bottomed within 1 to 3 months of the worst of the cuts to revisions. And what we've seen since that point is the estimates are still coming down. The estimates are still falling. That means all lanes here still require multiple expansion. However, it's justified because the estimates are getting cut at lesser and lesser rates. And that's improving earnings expectations. And to us, that's justifiably leading to rising stock prices.
Yeah, I remember, Nick, when you and I first met, you started talking much more about rate of change in a way that I'd not really thought about. It really changed the way I think about earnings season and how to prepare for it. Let's get to your final chart, which is talking about one particular sector, I think, where we are seeing this alligator jaw pattern. Tell us about the energy sector here.
It's the only sector. And that's going the first quote was Sir John Templeton about how the market cycles work. But I also love the adage, don't fight the Fed. And because they control a variable that impacts. And the Fed wants to bring down inflation. We all know that. It's in a battle with that. And energy is part of it. And what we had, particularly there's the energy prices ran up so much. And if the Fed's bringing down the price of crude, and we've seen commodity prices come down, the earnings have to go as well. So this is a chart from March. We've been bearish, maximum bearish on energy all year. And it's did well today. We don't think it's going to be still sustained until the Fed completely waves the victory flag on inflation and says we're done. And then we can allow that to grow. But we're still short energy. It's the only sector out of 11 where we're seeing an alligator jaw open that we were still warrant caution on.
Super helpful, Nick, to go through these, especially as we get into the meat of earnings season. We see a lot of potential, a lot of concerns about upside potential. I will certainly be looking for this alligator jaw, and I know others will as well. Nick, great to see you again. Please say hi to Northeast Ohio for me, and I'll look forward to having you again on soon.
Thank you.
That's Nick Raich. Nick is the CEO and founder of the Earnings Scout. And again, we just touched on some of the great expertise that Nick has. I know when we sort of get into the meat of earnings season, I'm drawn back to my conversations with Nick over time, thinking about the rate of change, expectations, and how reality relates to those expectations. I love this relationship between earnings and earnings season and what these companies are saying versus and the expectations versus sentiment and recognizing where we're at in the cycle. I don't disagree about that optimism take. I think that's pretty good. We'll see what sort of signs we can find that we may be at the end of that optimistic phase and rolling over as the markets become more extended. Great take there from Nick Raich at the Earnings Scout. Folks, we got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here is chart number 1. I had a sense that my guest today, Nick Raich, was going to talk about sentiment, and I love that John Templeton quote. It's a famous quote, just thinking about the different phases of investor psychology, really the sentiment of investors as a cohort. And what I was looking at earlier today was the Name Exposure Index. We haven't talked about this index in a little while, but essentially it's a survey of money managers and asking what their allocation is, what their weighting is in the equity portion of their portfolio. If it was at 100%, that means their portfolio is 100% in energy. You can be leveraged long. You can't have, double long and then zero. You can be short or double short. So it gives the opportunity to have quite a bit of range in positioning. Any level below about 30, 40% is incredibly lightweight or underweight in equities. Anything above 100%, what we call leveraged long, pretty heavy. What's interesting is we've gone up quite a bit. In September, October of last year, right at the time the market was bottoming, this indicator went below 20% for the first time since the March 2020 low. From there, it's chopped around quite a bit, but right now, the weighting, most recent reading around 93%, the highest we've been since the fourth quarter of 2021. So if you look, there's been sort of this underweight, sort of the skepticism of the rally. When Nick mentioned being in the optimism phase, I'm thinking of this chart, which really confirms that. It's sort of a healthy exposure to equities, but not excessive. The excessive reading is what would tell me we're starting to get to that later stage when you might want to start to expect some sort of market top. For now, sort of slow and steady, solid bullish positioning. Chart number 2, let's look at the two key banks reporting today. Bank of America, Morgan Stanley. And we look at these two charts. What's consistent about them is what I want to talk about, right? Both of them found support and a fairly consistent support level. You can see that Bank of America bottomed out a number of times around $27 a share. $82 was a similar level for Morgan Stanley. Overall, the longer-term trends have been very different, but both of these have found some short-term support and now starting to break out. Morgan Stanley with the move today, getting above the highs from April. Bank of America just barely doing so. When I'm looking at these charts, it's all about follow-through in my mind. Do we continue to push higher? Do we show that there are additional buyers willing to not just push it to resistance, but through resistance, representing some additional demand coming in? That's what I'll be looking for on a sector like financials. I think the proof is still left in the price, and we're not quite seeing enough validation just yet. Finally, gold. We talked in our market recap about a fairly defensive area of the market, usually expecting with gold. The dollar has been fairly weak. The dollar breaking down gives room for gold and other assets to push to the upside. You're seeing a nice move higher off of the June low to where we're at today. As we've revisited this chart every couple weeks or so, you can see how beautifully it's followed this framework, this Fibonacci framework, which means when you have a big move like the November 2022 low to the May 2023 high and you come back down, those Fibonacci levels can often be a really really important area to maybe anticipate some support. What's interesting is that support has held, and we're now back above the 50-day moving average for the first time since early May. I think that's a nice rotation to the upside, a nice break above moving averages, nice break back above resistance after finding support. The momentum is what's really interesting to me here. I would love to see if the RSI can remain above 60, at least above 50, which suggests overall more upside than downside for gold. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close. A special thanks to Nick Raich from the Earnings Scout joining us from Cleveland. All of our previous interviews are on our YouTube channel, so don't miss the opportunity to learn from some fantastic experts and traders and market practitioners. For Stock Charts in Redmond, Washington, I'm Dave Keller. Be well, stay safe, have a good night.